This conference will now be recorded.
Good morning everyone, and welcome to a fresh new session on IFRS9 Impairment Model Development Validation. So, just a very quick recap of the discussions that we were into. Right? So we started talking about the different financial statements of the bank and where is it that the role of provisioning comes in. Also, we had been discussing about the assets. So we talked about where is it that exactly the Basel CCAR default regulations come in, and where is it exactly that IFRS 9 comes in, right? And also, once we had discussed the basics of IFRS 9 and the the justification of the requirements of IFRS 9, the next thing that we started talking about was uh, and so what we started talking about was the basic scope of IFRS. So what are the scope of the assets to which IFRS 9 applies, right? And we started talking about the personal loans. So we started talking about as to like different assets, right? So how would I look at a given asset from a regulatory perspective in Basel and CCAR, and how would I look at it from at a provisioning level in IFRS 9, right? So this is something that we had been talking about, and in the last class we saw how is it that so we had a discussion about the SPPI, the sole principal and payment, the sole payments of principal and interest criteria, that is the cash flow characteristic criteria, right? And and we talked about how is it that the different so we talked about the concepts of delinquencies and how is it that this becomes important in defining the impairment in the data, right? So similarly, what we also started talking about was the different kind of lending books that the bank had, retail, commercial, and we started looking into the different characteristics of each of them. However, what we did was we had started off with personal loans. So what we'll do is we look into each of these. We'll use personal loan as an example. We'll look across different characteristics of IFRS. We'll assess the key features of IFRS 9 using personal loan, and from there we move to mortgage, auto loans. Then we'll talk about revolving products, overdrafts, credit cards, etc. Right. So now, before I move on further, so Harish has a question with you that what is the difference between Basel IFRS 9 and CCL expected credit loss from a regulator's point of view? Okay, so so basically, Basel, as we had discussed, is a capital uh, adequacy requirement, right? So when I'm talking about Basel, Basel is there to ensure that the bank is adequately capitalized. So the capital allocation that we do using Basel is that capital is used to absorb the unexpected losses. Right? So similarly, IFRS 9 and CECL are provisioning requirements. Now, IFRS 9 is IFRS 9, as we have discussed, stands for the International Financial Reporting Standards 9, right? So, the IFRS or the International Financial Reporting Standards is a basic or it's a requirement under the International Accounting Standards Board. So, it is the reporting standards which follows the IASB accounting guidelines. Right? Now, internationally, we said that there are two accepted guidelines of accounting. Right? One is the GAAP, the other is the IASB or the International Accounting Standards Board. Now, the GAAP or the general accounting principles are, the regulations that they follow, the provisioning regulation that they follow, or the computation of expected credit loss under GAAP was first proposed, was first followed as per the financial accounting standards FAS standards FAS 5 and FAS 114, but now they have been replaced by CECL. Now FAS used to previously use either a incurred loss approach, or they used to use the Basel next 12 months ECL. Now CECL stands for Current Expected Credit Loss More Framework. So CECL is the US counterpart of, or the GAAP counterpart of IFRS 9. Now both these regulatory standards are talking about the provisioning requirements, right? So for example, I'm a regulator, I'm the European Banking Authority, right? Or it's the Prudential Regulatory Authority, and I'm in charge of assessing whether the provisions are adequately maintained for banks in Europe, right? So I would be seeing the regulation that I would be looking forward to is the IFRS 9 regulation. Now, if I am the Federal Reserve of US, right? The Federal Reserve, and I want to assess whether Citibank has its uh, has maintained the provision as per the is adequately provisioned or not, then I will be looking into the CECL guidelines as a framework. Right? Whereas if I'm to do it for say Royal Bank of Scotland, the regulation that would apply is IFRS 9. So these are all IFRS 9 and CECL are alternate provisioning requirements who talk about computing similar kind of expected credit losses, forward-looking credit losses, right? Which would help the bank take a preemptive action against the riskiness associated with the borrower. We are, however, not concerned. So Basel, however, is a totally different kind of a concern. So while IFRS 9 and CECL lay down the framework, the guideline to ensure that the bank adequately provisioned and they have sufficient amount of money kept aside to absorb the expected losses of the portfolio losses, Basel lays down the guideline to ensure that the the unexpected losses are absorbed. So that is basically the difference across these three regulations. So IFRS and CEC are provisioning standards. IFRS is the provisioning standard to be followed by European banks, and CCL is the standard to be followed by the American banks, right? So that's what the difference is. Now, how is CECL more different from IFRS 9, or what are the basic differences? To get to that, right, I need to do some kind of an additional research because CECL is something on which I have not worked off as of now, right? I'll be talking about CECL later down in the module, but over here, the standards, so my concern primarily is with the IFRS 9 standards. However, yes, towards the end of the module, I have to do a comparison between IFRS 9 and CECL. So that's where I think I'll be able to cover it in more detail. But before I reach to that part, I would need some research at my end because CECL is something which I have not worked hands-on, right? So I've been working mostly on the Basel side, IFRS 9 side. I have not worked on the CECL. Rather, even for Basel, I work on a variant of Basel, which is for the European Bank, which is the CRD4 directives, right? The Credit Requirement Directives 4, so which is a variant of Basel, which has been customized for the European geographies. So this is what I have been working on. So these are the two things that we'll be focusing on right now. And as we go ahead, I'll be talking about CCL as well. But that's so whatever I've said is the basic definition, the difference, right? So if I'm an American regulator, if I'm the Federal Reserve auditing for Citibank, I look into CCL, see for CCL compliance. If I'm Prudential Regulatory Authority who is auditing Royal Bank of Scotland, I'll be looking for IFRS 9 compliance. That's it. Clear, Harish? Any other questions? So are we good up to this point? Great. So let's get back, right? So as I proceed, I'll also be kind of now my objective over here is now to use each asset and walk you through the different phases of IFRS 9. Right? So what is IFRS 9 all about? So once we have created the framework, right, for one asset, then we can do it for others as well. Right? So we'll explore different kinds of asset classes. We'll not only be talking about personal loans or auto loans or overdrafts, we'll be talking about different kinds of other assets. Like we'll talk about a lot of commercial assets at this point of time as well. Right. Okay. So just to kickstart, right? So there has been a couple of queries which I have received around the cycles of delinquency. The reason being that in the the IFRS9 second recording that I had shared, due to network issues, a part of it could not be recorded, right? So there is some missing content in between, and that is where the cycle of delinquency has been discussed, but it was missed out. So what I'll talk about is that what are the cycle of delinquencies? I'll just talk about this and refresh this idea, and I'll move on. So when I talk about cycles of delinquency, I'm talking about CD0, right? So cycles of delinquency. What is delinquency? Delinquency is when a particular borrower misses out on his payments, right? So suppose every month on the 15th of every month I have to pay an EMI, right? I miss out that EMI for that month. So then I become delinquent. So the delinquency is calculated in terms of DPD. D stands for days, P stands for past, D stands for delinquent. So days past delinquent, DPD. So a CD0 balance is your non-delinquent. So what is CD0? C stands for cycle, D stands for delinquency. CD stands for cycle delinquency 0. It means that I am in the 0th cycle of delinquency. So that is, I am not delinquent at all. And delinquency is generally measured in terms of days or, yeah, in terms of days. So say every 30 days of delinquency, you roll to the next cycle. Let's say I am supposed to pay my EMI on the 15th of every month. Now, in December, I miss out my payments, right? And what I do is I roll on instead on 15th, I pay it on the 20th of December. So what happens is instead of 15th was my due date, but I paid it on the 20th, and hence the difference. So the 20th minus 15th is 5 days. So I have been 5 days delinquent. Now, if I am delinquent with 1 to 29 days, right, as on the next reporting date, I lie in the CD1 bucket. So I lie in the cycle, in the first cycle of delinquency. Now, when my delinquency rolls over to the next, so when once I exceed 29, I go to 30, I hit the 30 days definition. So at 30 days, I'm standing in the second cycle of delinquency. So if my days past due from the due date is anywhere between 30 to 59, I am in the second cycle of delinquency. If I am from CD3 to CD3, if I am like in between 60 to 89, I am in CD3, and in CD5 I am 90 to 190. In CD4 I am 190 to 190, and so on, right? Now, using this period of delinquency, we can define the bad definition. So, when does a borrower become bad? A borrower becomes bad when he has been subsequently delinquent for a continuously given period of time. So, I am delinquent for 90 days at a stretch, or 90 days at a stretch. So that then it becomes, so I start going back. But what is the cutoff corresponding to which a particular account should be labeled as bad, right? So there are multiple analyses that we had talked about, one of which was a roll rate analysis, right? So the objective of identifying a bad definition is, or the way to identify it is that it is that part where on an average once an account, if an account hits that bucket, it hardly returns back to current, right? So the point from where the roll rate suddenly increases is the
So Tanmay,
cutoff.
I have a
Yeah. Hello.
Tanmay, I have a question here. So in a same data set, yeah, in a same data set which we have, we'll have
Mhm.
all type of
Mhm.
accounts or all type of observations which are CD0, CD1. CD2, CD4, and CD5.
Correct.
Yeah, and
Mhm.
CD3 is missing, I believe.
Yeah. I missed out writing CD3. So CD4 over here is CD3 and CD5 is CD4. So
And
I
that
just missed
and
out.
that credit and that credit directive 4 which you talk about European standard is different from this CD was 0, CD1, CD2,
No,
CD5.
no, 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 no. That's a CRD4. That's the regulatory
Okay.
standard, and this is cycle of delinquency.
Okay. So that is CRD and this is CD. Okay.
That's credit requirement directive 4. That's like IFRS 9. So that's the fourth standard issued by the regulatory authority by the credit requirement directive board. Right. So that's a regulatory
Got it.
standard, and this is cycle of delinquency. So there is a big R in between the two,
Tanmay, can you come again on this
right?
roll rate concept if you can?
Yeah, I'm coming to this rule rate. I'm coming to this rule rate. Okay, so the way it works is I'll just open an Excel sheet and I'll show you how it works. Just give me a second. Uh-uh. Okay, so over here you can see an example of a rule rate analysis, right? Let's have a look at this. It says that let's look into this table, right? So it shows as on date. So you report your portfolio or your balance, delinquency wise balance concentration at the end of each month, right? And this is an assumption, and yeah, so it generally happens that way. So what happens is on 31st Jan 2016, I see that on my current account. So these are the non-delinquent accounts, or these are the active accounts which are on the on-book accounts. So all these are on-book accounts, but these are non-delinquent accounts. I see that okay, as on 31st Jan 2015, there is the number of accounts on the books is 1 lakh, right? Now, in the second part, so there are 40,000 accounts which are on the books of the bank on, between 1 to 29 days past. So there are 25,000 accounts which are between 30 to 59. There are 10,000 accounts which are between 60 to 80,000. Sorry, these are all your balances. This is in terms of balances, not accounts. Right. Now, what I see is that when I reported on 28th Feb 2016, right, so I see that yes, some new more acquisitions have happened and the balance in this part is has gone up to 2,08,000. However, what I also see is that from this 1 lakh, some 45,000 has flown down to the first bucket. So balances out of the 1 lakh balance which was there in the current in CD0 bucket, out of that 45,000 has become 1 month, 1 to 29 days delinquent in 25th Feb. Right? So 1 to 29 days of delinquency, this has just flowed onto this bucket, right? So now so this is how the flow rate is measured. So what is the flow rate over here? So if you have a look into this, so the flow rate has been considered in this next table. So this part shows how much of the balance has flown from CD0 to CD1. So this is D20 by D69, D19. Sorry, C19. So this is D20 by C90. So 45,000 out of 1 lakh for the last month has flown now to become 1 to 29 days past due, right? Okay. So the next part that we have over here is that, okay, in 31st Jan, there was 40,000 rupees or dollars, whatever the currency is, a balance of 40,000, which was there, which was one cycle daily. Now 20,000 of them has flown down to 30 to 59 days past due, right? So 20,000 of this balance has rolled over to the next bucket.
Tanmay, so as on 31st January 2016, there were 1 lakh accounts, right?
No, this is the balance. This is the balance. So in as of 31st January, in
Okay,
CD0
these are
buckets, there was a balance of say 1 lakh rupees. Right. Now
which
out
were
of that 1
non-delinquent,
lakh,
which were not
non-delinquent.
delinquent. Okay.
Correct. So after 1 month, so that is on 28th of Feb, 45,000 account, 45,000 was balances that flowed to the first cycle.
So, and remaining 55,000, they didn't default, right?
No, this is not defaulting. This is they have just one delinquent, one cycle delinquency.
Yeah, yeah.
Delinquency, no,
I
no,
got your
default
point. So
and
they are delayed.
delinquencies
So they
are
are delayed.
separate.
Okay. So they are delayed. Delayed. They haven't paid their dues.
Correct. So how does this happen? Now you can see that from 40,000, 20,000 flew to the next bucket, right? That means 40,000 or 20,000 accounts or 20,000 balance, right, had remaining 1 to 29 days past due, right? So it may be that they paid their balances. So some adjustments have happened and 45 final resulting number of account balances, resulting balance in CD1 as on 28th February 45,000. So the flow rate that I have over here is 1 lakh 45,000 divided by 1 lakh. So the flow rate over here is 45,000, right? I mean 45%. So is this concept of flow rate clear?
So this 45,000, like these are past delinquent, right? Like in CD1 bracket it has come, right?
Right. So as on 28th Feb 2016, this much of balance is CD1, right? So what are you confused about, Umang? Tell me.
No, so our 1 lakh balance was there as on 31st January, but on
Hmm.
28th Feb, 45,000 have come. As in these are delinquent past
Yeah. So
like
out of that 1 lakh, right, 1 lakh balance, which was non-delinquent last month, right?
hmm.
So say up to December, I have paid all
No,
my
I got your
dues.
point. Understood. Then there would must be remaining 55,000. So where those 55,000 which are non-delinquent now, where are those? Like
Mhm. Yeah,
those
so
come
those
under.
are adjusted over here. So they are still non-delinquent. So as on Feb, they are non-delinquent, right? So
Okay,
from
okay.
this 1 lakh, some 55,000 has still remained non-delinquent this month, right? Some new acquisitions have happened, and the gross
Okay.
balance in this bucket as on this month is represented here in the cell C20,
Okay. Got it. And then this
right?
40,000 is what? 40,000 this 31st Jan
Okay,
2016,
the
40,000.
40,000 is as on 31st Jan, this balance was already CD1, so it was already one cycle delinquent, right?
Okay, okay.
In that one. Now, one cycle delinquent means what? That what are the possibilities? Now, first possibility is I do not pay this month and I flow to the next bucket, right? The second possibility is I pay only this month's installment and I remain in CD1. So, which is this cell. So this the 45,000 over here will also comprise of accounts which were CD1 last month and CD1 this month as well. Right. Now, The third option is I pay 2 months EMI together and I go back current. In that case, there will be a flow back to this. So this to then in that case, from 40,000, this will be the. I mean, some accounts will be there which will also flow back to CD0. However, we cannot see that like that. So when if we want to find out, we have to do appropriate calculations and adjustments to find them out. But over here, what we look into is okay, there was 1 lakh balance, 1 lakh balance there. As on then, out of that, some balance has flowed over here. Right. Now,
So
so
Tanmay, just a quick
yeah.
question. Sorry to interrupt.
Uh-huh.
So this
Mhm.
40,000 in the CD1 bracket can also be accounts which went into CD1 in December and just stayed there for 2 months.
Uh, 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 Absolutely, absolutely. So however, when we compute the flow rates, we compute the gross flow rates. Now, if you want, you can compute the net flow rate also. So there is a way to compute net flow rates. So where you adjust for all these and you see how much net from this 1 lakh has flown into this bucket. So you can do adjustments as well. So I'm just broadly talking about the roll rate concept. So when we do this, we'll be doing these adjustments as well. Right.
So what's so this flow rate and roll rate is one and the same thing, or roll rate's definition is something else?
See, in roll rate analysis, what we generally do is we look into the gross flow rates, right? Now, the approach where we look into the net flow rates, so there we do all these adjustments and we compute the net flow rates. Now, net flow rate is generally use a loss forecasting model. When I'm doing the roll rate analysis, we just look into the gross roll rates. So, as on this month, as on Jan, what was the CD0 balance? Right? As on Feb, what is the CD1 balance? So CD1 balance divided by CD0 balance. So we do it like that for flow rate. Now, I mean for roll rate. In roll rate analysis, what our objective is to identify that time when the flow, once an account flows to a higher bucket, there is hardly any chances of recovering back, right? Let's say, for example, if I look into this first flow rate, 45%, or the second flow rate from CD1 to CD2 or CD2 to CD3. So you see that they are more or less around 50 to 52%, right? So from CD0 to CD1, the flow rate is only 51. 45, that means 55% of the balances do not flow, right? From CD1 to CD2, it's nearly 50%. And from CD2 to CD3, it is 52%. Now, if I say that my CD3 is my bad definition, what it means is that 52% of the accounts flow to the higher bucket, but 48% roll back or stay where they are. So that means you cannot actually say, or very conclusively reach to the point saying that no, there is a significant flow in the flow to the like upper buckets. There is a 50-50 chance. So CD3, CD2 or CD3 is not a bad definition. It's an indeterministic definition. Now, balances which are in CD1 or CD2, can flow to the higher buckets, may roll back as well with a 50-50, nearly a 50-50 chance. Hence, this cannot be a bad definition. Whereas, if you have a look into this flow where, you know, from CD3 to CD4, the flow rate that has been there. So once a balance hits the CD4 bucket, right, you see that there is an 85% chances of going bad, right? I mean, once a balance bucket hits the CD3 bucket, you can see that 85% of the balances flow up, followed by 90 and 100. So you know that historically, once you have done it for multiple years, you know that once your account hits the CD3 balance or the CD3 bucket, accounts or balances which hit the CD3 bucket have hardly any chances of recovering back. So there is an 85% chance that it will flow to the CD4 bucket, followed by 98% and 100%. So you know that your CD3 plus, so once your account has hit the CD3 bucket, your account has become bad because hardly there is a chance of rollback. right? So CD0 and CD1 over here are good borrowers because majority of them flow back, right? CD2 is indeterminate because the flow rate is nearly a 50-50 chance. CD3 plus is the bad definition, right? Yeah, tell me what is not clear. Hello?
Yeah,
Yeah,
yeah.
Umang, tell me.
So I got your point of flow rate, but
Mhm.
so the flow roll rate is as good as in a way flow rate only, like to assess
Huh.
the definite. Right? Yeah,
See, the
in a way.
concept is more or less same. The concept is more or less same, right? So in flow rate, we often look in, see, roll rates are nothing but the way the accounts or the balances are flowing up, right? Now,
Okay,
what
okay.
differs in the calculation of the flow rate? Over here, I'm just using the gross rate. I'm looking to the gross flows. Over there, when you are developing a loss forecasting model, you look into the net flow rates. That's the difference. So this is a very crude example just to demonstrate how roll rate can be used to define a bad definition. That's it. To talk about, to explain the difference between delinquency and defaults. That's it. Right. So this doesn't involve any accurate calculation. So when we do roll rate analysis, we'll look into the calculations and all. So that is what we will do. Right.
Yeah, got it.
So don't go into the depth of the calculation. Just look into the pattern of the figures and the way the conclusions are derived over here. Because we're just trying to understand the framework first. So once we are done with the framework, then we can start talking about the calculation and going into the depth of the technicalities gradually. So is the concept of roll rate clear to you? That's one. Second, on what basis are we defining the good, bad, and the indeterminate, right? And the difference between delinquency and default. So are these three concepts clear to us? Then we can move on to the next part. And when we develop things hands-on, we'll come back to these calculations in details.
Yeah, yeah.
Right? Good. Okay, fine. Fine. So this is precisely so what we were talking about. So now, after we talked about delinquency, bad definition, we started talking about in the last class about the assets, and we took up personal loans, and we saw and we tried understanding the concept of SPPI, that is sole payments of principal and interest. So that is also known as the cash flow test because the first challenge or the first objective in the IFRS 9 module is to decide the scope of the assets which will fall under IFRS 9. And we saw that there are multiple assets, like there are multiple assets the bank's balance sheet has, right, or the financial statement has. Now, how do I know that which of the assets are to be used for, or which of the assets to which IFRS 9 calculations would apply, right? And for doing that, the next thing that we need to understand is what are the assets that fall under this group. And we see that there are three broad type of assets which IFRS 9 talks about. So one of those assets are assets at amortized cost. So that is the one that we had talked about in the last class, right? So we did a lot of talking about amortization and amortization schedules. So the first thing is the assets at amortized cost or AC. So assets which are valued at amortized cost, those assets would be used for, or they apply for impairment computation using IFRS 9 framework. Amortized costs. The second that we have is the FVOCIs, that is fair value to other comprehensive incomes. Right, and the third that we have over here is we have amortized cost, we have FVOCIs, and the third that we have is fair value through profit and loss, FVPTL. So FVPTL contains assets like derivatives, exotic options, etc. So which are left outside the scope of impairment computation using IFRS 9. Excuse me. So FVPTL is outside my scope of analysis.
Then what are the methods which okay, FBPTL is again it's something I related to accounting. It's a direct mathematics which we will apply to calculate the FBPTL. There is no complex technique to use to calculate this. Is that right?
Yeah,
Okay.
yeah. So over here, now what is so specific about these two groups of assets, amortized cost and FVOCI? So they satisfy the SPPI criteria, which is, as I called, the sole payment of principal and interest. And the asset that we started talking about in the last class, right, that is personal loans, is a typical example of an asset which is valuated or valued at amortized cost, right? So once you value an asset, right, then the next question comes is how to assess the impairment. And as we have already seen, IFRS 9 talks about a very comprehensive way to compute the, uh, you know, to compute the difference, to compute the impairment on the asset. And to do that, what they have talked about is a staging approach. So they talk about staging the assets into stage 1, 2, and 3, right? And for each stage they have defined a definition of the expected credit losses, right? So that's the next part of the discussions that we would have. So just go through this framework for the next 2 minutes and I'll just get back. Just give me a couple of minutes. Okay, so I have a couple of questions. Okay, I'll just take up these questions from Piyush, and then we'll just move forward, right? So the first question that Piyush has with me is that when does the customer gets charged off, written off? Now, Piyush, when we talk about charge off or written off, there are certain charge off policies that the bank has, right? Now, for retail, mostly it is at least for credit cards, it's around 120 to 180, right? So some write it off. Mostly it's at 180 that they write they charge off the credit cards, and so a credit card is blocked and everything is taken off the books and put into collections. But the account becomes bad when it hits the 90 days past due, right? As per Basel definitions. As per business definitions, it can be different as the results come out from the roll rate analysis. But the charge-off is around, so if the bad definition is 60, the charge-off happens at 120. If the bad definition is 90, charge-off happens at 180. So that is as per the collections policy that, so every organization has their own collection policy, their charge-off definition, their default definition, and so on. Piyush, I think your video has been clicked on. Yeah, that's fine.
Oh, sorry. Yeah.
No,
So,
not yeah.
yeah. So what I was saying is, so first the account goes into like default, then it goes into collections and recoveries, and then gets charged off. Is it like that?
Yeah, so basically, see, now there are some organizations who make a difference between write-off and charge-off, right? Say, for example, my account hits the bad definition, right? Then what I do is write it off from my books. So accounts more than 90 days past due do not appear on my current account, current books. So I maintain a separate write-off file for them. On the other
Mm-hmm.
hand, it can also be that, and then I put it into collections. After collections are done, I write it off I charge it off after a point of time.
Okay.
Or the other way it can happen is that I hit my 90 days past due, right? A write-off flag is created corresponding to me, but I still am maintained in the books of the bank because I'm trying to pay back some money as and when I can, right? And
Mm-hmm.
then I'm placed to recovery, and then finally, also once I hit 180 days, I'm totally charged off from the books. Right. So again, there are concepts of net charge-off, gross charge-offs. So, but generally, when we say charge-off, we mean that the account has hit that charge-off definition. But every bank is, again, I'll say that they have their own internal definitions about charge-offs, right? So that's one. And to your second question, yes, what IFRS 9 is to the European banks, CECL is to the American banks. And so this is a discussion that with which we started. Harish brought up the same question, right? So if you go through the recording, once I share it with you, you'll get the entire detailed explanation of the same. Because I have done that, I'm not going for it again,
Okay. No
right?
problem. So, okay. Loss
Yeah.
forecasting is just for US, right? Like,
No. Loss forecasting is not your CECL or ECL. CECL and ECL are your regulatory models, right? So then they are your provisioning models. Loss
okay.
forecasting models are business models. Like scorecards are your business model,
Mm.
and your say your behavior scorecard is the business model, and PD is your Basel model. So that needs to be submitted to the regulator to for capital calculation and accord calculations, right? On the other hand, when I talk about the other side, when I talk about behavior scorecard, they're used for business purposes. Similarly, loss
Okay.
forecasting models are business models. So I forecast the loss to get an idea about how this thing works and how is it all about, right? So how the losses look like, what are the how the portfolio losses evolve. We're trying to predict that. So that's a business portfolio. That's a business exercise again, because there are a lot of business assumptions which come in. In regulatory model, business assumptions do not come in. Right. So CECL is a provisioning model. Yes, you are computing an expected loss, but there are certain regulations which are built around that ECL, which may not be there when you are calculating a net flow rate model for loss forecasting.
Thank you.
Right.
Yeah. Thanks.
Okay. Okay. So any questions up to this point? Or then we'll next move ahead. Okay, fine. So let's just let me again, kind of put the thing into perspective. So in the last class, we talked about personal loans. We saw how amortization happens, right? What are the formula for amortization, and why is it that it passes the sole payment of principal and interest rule or the cash flow characteristic. So now that this asset has passed the test, it enters the value. Now we need to assess the impairment for this asset. So what are the chances of impairments in this portfolio? And for impairment, IFRS 9 talks about a staged approach: stage 1, stage 2, and stage 3. So in today's discussion, we will focus on the staging model, right? How can staging be done, and what are the ways of doing the staging analysis, and corresponding to each stages, what are the loss expected credit loss figures computed, right? So this is the part that we will be talking about in today's discussion, right? So your personal loans portfolio has been valued. So obviously observe one thing, that unlike Basel, right, you just do not directly jump into the model development exercise over here. Over here, before you, since it's an impairment model, you also need to understand how is it that the asset needs to be valued. How is it that the asset needs to be accounted, and how is it that the asset needs to be valued? So this accounting part with IFRS 9 is very critical. Now I'm just first of all discussing the core portions, right? And then we will gradually move ahead and we look into different assets as well, and we look into different asset classification rules and different regulations as well. But first I'm just trying to get into the crux of IFRS 9, the heart of IFRS 9. So now I have my personal loans portfolio and I want to assess impairment. That is what my objective under IFRS 9 is. So assess impairments. Right? So assess impairments. Now to assess this impairment, first of all, there will be a impairment definition. There will be an impairment definition. So when do I consider my asset to be impaired? Definition. Now, unlike the incurred loss model approach, the impairment over here is predictive in nature and not adaptive. And what I do is that so how do I make this predictive? I make this predictive by incorporating, my account management strategies into, or my account management team into the story the moment I assess a loan. So the moment I give out the loan to a particular borrower, what I do is I make my model predictive in nature by preemptively tracking the behavior of this account. And I do not actually wait for this account to go into real default. So over here, what I do is basis the behavior of the borrower. So basis the behavior. So basis the behavior, right? The account is staged. Account is staged into three parts. One is stage one. The next is stage two. Yeah. The third is stage three. Now, accounts which are in stage three are those accounts which have satisfied the impairment definition. So stage three accounts are accounts which have right stage three. So stage three accounts are accounts which satisfies the impairment definition. And we generally say that an account is impaired when the account is a bad. Is a bad account. So that is an account which has satisfied the bad definition. So when I talk about the bad definition over here, I need to understand something. I need to understand that what exactly is this bad. So how do I define bad? Now IFRS 9 says that an account is bad if it is 90 days past due. 90 DPD or 90 plus DPD. +90 DPD. So the question that comes out is that Basel also talks about 90 plus DPD. IFRS 9 also talks about 90 plus DPD. Then how are these two different? So these two are different in the following perspective. That IFRS 9 reads a flexible and open-end to this bad definition with something called the rebuttal analysis. It's called the rebuttal analysis. So what is this rebuttal analysis, the rebuttal analysis? Now, under this rebuttal analysis, now this rebuttal analysis helps or distinguishes IFRS 9 from Basel, because Basel is a capital adequacy accord. Right? It has to have certain conservative, certain stringent aims, right? And it should not be impacted by the business characteristics of the model, right? Because Basel is trying to predict or trying to ensure that the capital which is kept aside is sufficient or not, and hence it's working with the balance sheet item. However, IFRS 9 is often working with provisions. Now, provisions are that a business needs to keep is absolutely, it's required absolutely for, so provision is absolutely dependent on the business characteristics. Therefore, this function or this must have the or this code must have the part where or this regulation must have a part which aligns this regulation to the business characteristics of an organization of a firm, right? So while it says that an account is bad if it's 90 plus DPD, but it leaves an element of flexibility to the business by providing the rebuttal or the rebuttal analysis, where it says that if it's not 90 days past due, the the financial institution needs to provide substantial evidence that they will not, they will be rebuting 90 days past DPD and they will be accepting their own bad definition. So I need to provide a rebuttal analysis and I need to show them that yes, this is where that my bad definition is not 90 days past due, but rather it is something else. It can be 180 past due, it can be 365 days, it can be 60 days past due. So if it's not 90 days or something near to 90 days, then, or if it's something more different from it, then what you do is you perform an analysis and you rebut the definition of 90 days past due, right? Otherwise, you can just go ahead and compute it at the 90 days past due, right? So often to do this rebuttal analysis, right, the flow rate or the, as I said, the roll rate analysis becomes a very handy tool. So roll rate analysis, rebuttal analysis often use the roll rate. Right. Yeah. Yeah. Tell me.
So Tanmay, this if the account is bad, if the cycle of delinquency is above 90 days, so IFRS says it's a bad account, right?
No, no. I mean, it says that if your account satisfies the 90 days past due definition, right, it's a bad account, right?
Yeah, if
Now,
it has gone above 90 days, so it's a bad account. This is what IFRS says.
yeah. So IFRS uses the no conventional definition. However, it does not remain very rigid on that. Unlike Basel, like Basel says, by if it's retail, it's 90 plus DPD, it's bad, nothing doing. But IFRS 9 does not apply only to retail or commercial products. So it also, because the way you define your bad definition will lead to the estimate of your provisions, right? And so therefore, the bad definition should be aligned to the portfolio. Now, in retail, it's 90 plus DPD or 60 plus is flat. It's more or less similar. In, I mean, because it's retail portfolio, there is not much of variation. You give loan to a salary guy. If he doesn't pay you for 3 months at a stretch, he is to flat as a bad. That's conventional. Now, think about a commercial portfolio, right? Commercial lending or commercial repayment do not happen the way it happens in retail. There are certain contracts which drives the payment, right? Suppose I have a certain bill of exchange. I have a certain bill of exchange where I say that, okay, I'll pay you 120 days or 180 days down the line, or even 365 days after, like within 1 year, I get the thing. So and it's appropriately hedged with certain instruments and stuff like that. So what happens over there? Your bad definition is 365. Or what you do is in corporates or commercial lending, what happens is they insure that particular loan, right? So they insure that particular loan or the amount of receivables that is outstanding using some other instruments. So in such cases, using a flat 90 days past due becomes very challenging. So you should always have scope to help the businesses to align their bad definition basis their business, basis their terms of operations to the to the now to the regulations. Now, however, yes, if you have to provide a valid reason, a valid analysis to show that you are reviewing 90 days. You just cannot go and say no, it's 180 days or it's 365 days. So there has to be substantial policies of the business. There has to be certain historical evidence which show that yes, a 365 days bad definition is possible. So if the guy doesn't pay me back within 1 year, I'll flag him as bad, right? So there are so those analyses must be there. There must be a supporting analysis to show. And one of the simple analysis to do is a rule. That's what I'm saying. I'm not saying that rolled analysis is or has to be used to get that, but it's one of the ways through which you can get a you can perform the rebuttal analysis, right? So you need to show that okay, after 365 days, after a balance hits 365 days, then hardly rollovers are possible, or rollbacks are possible. So this is how the analysis is done. And impairment. So
And
if once you satisfy your bad definition, you are at stage 3. Once your account hits the bad definition, it's a stage 3. That's the impairment stage.
so this impairment would be now like if it is hitting,
Yeah,
so
tell
this is
me.
a loss. Like
What
this is
else?
like a loss for the bank, right? In a way, this should be accounted in the
No, this
provisioning.
is this, no, 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 no. This is not a loss. It's still not a loss.
There are chances that will be
It's
recovered in
impaired.
future.
Now, of loss, correct. So there would be recoveries. Whatever you cannot recover is your loss.
Okay, okay. So the provisioning is based on the bad. If the
Right?
account is bad, the provisioning is based on the bad account.
No. See, once you see that
Oh,
your account is defaulted, right? You put 100% as reserves or as provisions for those accounts. Your prediction comes into play in stage 1 and stage 2. Stage 3, you know that it is. So once if your account has hit stage 3 or if it's impaired, right, then it's incurred loss, right? So you put aside the entire amount outstanding as your provision. Or say you have kept aside some provision previously when it was in stage 2, and then you keep aside the remaining amount as this. So at the end, it's 100% that is kept aside. Now, your prediction comes in stage 1 and stage 2. Right. So when an account is in stage 1, you are trying to assess what are its chances of defaulting or becoming impaired in the next 12 months. When he is in stage 2, you are trying to assess what is his probability of defaulting in the next over the next lifetime. So that is where the prediction comes in. Stage 3 is incurred. Once it hits, you know it's gone. Yeah, but still you do compute its lifetime losses depending on at what stage it is in stage 3, like what level of delinquency or what state, what kind of a state it is already in, right? So is it trying to recover back? Is it curing, non-curing? So there are a lot of these possibilities, right? But stage 3 is a stage where you have hit your bad definition, right? So that's what stage 3 is. Now, okay, so any questions are in stage 3? So your stage 3, or often your stage 3 provisionings are also governed by the IAS 39 standards. It is governed by the IAS 39 standards. So the IAS 39 standard is the incurred loss standard which was previously there, right? Now the IFRS 9 standards replaced the IAS 39. So IAS 39 standards provision basis incurred losses, right? So that provisioning standard is applicable to only stage 3. Now the beauty of IFRS 9 comes out through when an account moves from stage 1 to stage 2 to stage 3, right? So that's where the entire romance of this regulation is involved. So let's say I am a borrower who has been given a personal loan, right? So once I have been given a personal loan, the what would the bank start doing? The bank would start monitoring my behavior, right? So the bank starts monitoring my behavior and how is it that I am operating and all these things. So in stage 1, I am a non-risky borrower. So I am that borrower who is non-delinquent and active. Non-delinquent and active. I am a non-delinquent borrower and I am an active borrower. Now over here, I am the best borrower, right? So I'm non-risky and I'm just paying back my dues in time and I'm stage 1, right? Now what happens is I miss out on my payment or I become delinquent. The moment I become delinquent, right? So it means what? So as we saw from our discussions in the morning today, what happens when I go delinquent? When am I going delinquent? When my utilization or my credit propensity, propensity to consume credit exceeds my repayment capacity. So it means that there is a challenge in the repayment capability of the borrower. So the willingness of the borrower to pay back, of the repayment capability of the borrower to go pay back, has gone down. And then I face a significant increase in credit risk. So this is what we call our SICR. SICR stands for significant increase in credit risk.
Uh, so Tanmay,
Yeah.
this significant increase in credit loss or credit risk may be due to economic conditions as well.
If significant increase, if economic conditions change, right, then it would have an overall impact on the portfolio, right? So it would not be having an impact on a particular account. Now the staging
Yeah.
that is being done at an account level. So if there are 1,000 accounts which has been taken on the books of the bank, then basis their payment and basis their account, their monitoring of their account, if I see the repayment of a particular account has gone down, then it's moved to the next stage. Now,
So then, yeah,
significant increase in credit risk per se happens due to account level factors. Right. Now, the impact of the macroeconomic variable will be faced through a movement in the probability of default. So those variables they will enter while I'm trying to predict my PD, right? Or when I'm trying to predict the lifetime PD and so on. So that is where it will the macroeconomic variables come in. Now generally when macroeconomic factors would change and that would have an impact on the portfolio, right? So those kinds of cases or those would be reflected through, yes, the probability of default of the borrower, because given a set of factors, given an account management behavior, an increase in macroeconomic or a deterioration in macroeconomic variables can cause an increase in credit risk, right? But that would not happen, or that would have an impact on the overall portfolio, not only to specific accounts. Only if account level information change, the significant increase in credit risk will happen. And the way significant increase in credit risk is defined, it is defined in terms of account level information. It is not defined in terms of macroeconomic informations, right? Because so when I come to the significant increase in credit risk detection, right? So then you will see why I am saying it happens at an account level. Right, Anshu? Any questions? So anything that has been not clear in what you asked me?
yeah, right. That's
Because
fine.
I just, yeah, the reason I'm asking is because I felt that I digressed a bit. So has your question been answered or
Yeah, that's answered. Yeah.
okay? Okay, so once an account undergoes a significant increase in credit risk, and this is, I'll just put it over here as an observation. It's defined in terms of account level factors. Of account level factors. Now, to macroeconomic variables, will come down separately to that. The account level, right? Okay, so once the stage two, once an account falls into stage two, so what happens? So these accounts are accounts which are delinquent, but they are not impaired. Delinquent, right? So from stage one to stage two, they have moved, right? So from non-delinquent, so they have now become delinquent and they have significant increase. The questions, so two questions come up over here. So how do you define the significant increase in credit risk? So what are the staging criteria? So the question that comes out from here is, the question over here is, the staging criteria. So what exactly is a staging criteria? So how do you define a significant increase in credit risk? So when would you actually pass an account from stage 1 to stage 2? So that's where the concept of staging criteria comes in. Now from stage 2 an account moves to stage 3 when he satisfies the impairment definition. Impairment is right. So this is precisely what the stages are. So I move from stage 1 to stage 2 when there is a significant increase in credit risk, and I move from stage 2 to stage 3 when I've satisfied the impairment definition. Right. And for each of these two stages, these three stages, the regulation talks about two broad concepts of expected credit loss. So one of the expected credit losses which we kind of hope to see in stage 1, that we expect to see in stage 1, is the next 12 months loss. The next 12 months loss. So there's the next 12 months loss, which is 12 months ECL.
So Tanmay, but the of the
Yeah.
account only in stage one, if the account only has not is not delinquent.
Mhm.
So we are in the account in on stage one, the account is active and the borrower is making regular payments. But still we are like calculating the ECL in 12 months,
Right.
like in stage one only,
Right.
right?
Right.
And in stage two, when does this stage two come? Like after some performance window that you will calculate, like you will see, and then you will check whether this account is delinquent or not. If it is delinquent, then the impairment will come in the picture.
Yeah. So basically, see, suppose I am a non-delinquent borrower, right? So even if I am non-delinquent, you can compute my PD, right?
Yeah,
So I can compute my PD, I can compute my LGD, and I can compute my EAD.
correct.
But yes, my expected credit loss would be much lower than a borrower who is delinquent. Now let's say I become delinquent, right, and I undergo significant increase in credit risk, but still I am not impaired. I have just become delinquent. So that is where I come across stage 2,
Okay, and then
right?
stage two also you will calculate the 12-month ECL going
No,
forward.
no.
Okay.
When I enter stage 2, now I will not calculate the next 12 months loss. And this is where IFRS9 differs from what Basel does. In Basel, what we used to do is we used to have, say for detailed model, we used to have segments. Say our risk-based segmentation, I used to do delinquent borrowers, non-delinquent borrowers. For delinquent borrowers, I have a PD model. For non-delinquent borrowers, I have a PD model, right? And LGD, and I get expected losses for both the segments. But over here, IFRS 9 says that once you see that your account has undergone a significant increase in credit risk, you will not compute next 12 months for stage 2. For stage 2 and 3, you will compute the lifetime expected credit losses. And that is where IFRS 9 brings in a new framework or brings in a new turn into this, this provisioning story. So previously, क्या होता था कि we used to compute next 12 months loss, right, in the portfolio, and then do qualitative adjustments, backtesting, and all under the previous requirements. Now over here what we are doing is we are computing the next 12 month credit losses only when you are non-delinquent. The moment you become delinquent or you go into impairment, we are computing the lifetime expected credit losses. I'm computing my lifetime ECL. And when I compute this lifetime ECL, this is where I become more conservative in making. Because once he has been delinquent, I don't trust him anymore. I look into what his lifetime expected credit losses can be, and I put that aside right now. So I am guarded against. Now, if he goes into impairment, he doesn't. I am not bothered. Now, what if this guy had gone delinquent once, right? So I was traveling and could not pay my due, and or say I was changing jobs. I did not have salary for a month. I could not pay it back. The moment salary comes in, I just pay it off. So now, again, I go back to stage 1. So there is a derecognition process also in IFRS 9. So it's not that unlike Basel. So in Basel, what we used to do is once a bad, always a bad. Right? So in a performance period, as long as that performance keeps on coming in, you are in a kind of a challenge, right? So you know that yes, this borrower is always being flagged bad in the performance because there was a fixed performance period. So over here, the moment I pay back the money, right, immediately I am decoupled and I go back to stage 1. Now over here, ECL is being computed at a stage level. So I'm segmenting out stage 1, stage 2, and stage 3. For stage 1, I'm computing ECL. Whatever account is there as on that month, I'm computing them for all those accounts. So basically what happens is, when the account was in stage 2, I computed lifetime ECL, right? So that provision was relatively much higher. Now, when this account has been derecognition into stage 1, I need to keep lower amount of provision for him. So my provision next period goes down. So this not only makes the model, the estimation or the risk management process more robust, but it also makes it very flexible in the sense that the borrower, the borrower is also allowed to flow in between stages basis their performance. It's not that once you have been faced an SICR, you are always SICR as stage 2. If you pay back and you become current, you are now current. Your loan is derecognition. So derecognized from stage 2. And now for you, I'll be computing next 12 months losses. So obviously, my provision amount goes down. So that flexibility is also there in this particular modeling method.
So IFRS 9 is better off than Basel because
No,
flexibility
no,
is
no,
there.
no, no, no.
You cannot
No,
compare.
this is, or you can say this is a more specialized framework for provision. Previously, we did not have any expected loss framework, predictive frameworks. It was incurred loss approach. To make it predictive, businesses used to pull in Basel inputs. Now, Basel inputs have been created with a totally separate objective, right? So they are more stringent. Now, I want to compute expected loss. I am not concerned about staging. I don't want to know whether a borrower is flowing in between or not, whether is he dancing in between stages. All I want to know borrower is defaulted or not, because I want to know the portfolio level expected losses. And based on that, I'll be computing the unexpected loss. Because for Basel, the target variable is unexpected loss, right? So my target is totally separate, and IFRS is more specialized to that.
And impairment, what's the difference between impairment and delinquency? Like it's like past 90 days is
See,
impairment
no,
in that
no,
sense.
impairment is bad. Impairment definition is a bad definition. And delinquency is a case when you miss out a payment.
Okay, okay.
If I become delinquent for a consistent period of time, then I become impaired.
Okay, okay.
Right? So let's say I'll give you an example from my
Understood,
life.
understood, understood, understood.
Last October I did not pay any of my bills, right? I mean my credit card and all, because I did not have money last November. But this December I got my salary and cleared up everything. So I went delinquent and I came back current. But if I had not been paying back continuously, means what? That financially I have been impaired, my payment capacity has gone down, then I go and become impaired. So that I did not have to, so that the bank does not have to wait until I go impaired. It takes the first event of delinquency as an indication that I can go impaired in the future, and it places me in the second stage, or it passes me through an SICR and it says, okay, man, we'll compute lifetime expected losses. If he goes back to stage one, we'll see it there. So this is what makes this approach forward looking or predictive in nature, rather than waiting for me to go to the bank and tell you that, man, I lost my job 2 months back, I cannot repay, so I am going to default, so help me out. So in that way the bank cannot do anything but write it off or put in the provision over there. So in that case it was a backward looking approach, right? Over here you are just monitoring the behavior and you are trying to say, okay, this guy has missed out a delinquency, has missed out a payment 30 days. He is dangerous or he possibly can go into default. Now, if he pays back, we put him back to current. But for now, I'll compute the expected lifetime expected credit loss. Right. So it's similarly like that. Right,
Okay,
Umang?
yeah, got the point. So in this IFRS, so there would be like provisioning also. There would be stages like lifetime expectancy losses, credit losses, and then current expected credit losses like that.
Yeah, so they are computed at across stages, but when you report the provisions, you add up all the three, right? And a weighted figure. So you are weighted by macroeconomic scenarios and all. So I'll come to that. And then you report
Okay.
one single figure,
And then in
right?
impairment, do we calculate impairment if the account is impaired? Then do we calculate provisioning here?
No, we still compute the expected credit loss, but over there, when an account is in stage two, you can actually decouple between the principal and the interest, right? This much of principal left, interest left. But when an account goes into default, so say the account is defaulted, right? You don't decouple
Yeah.
principal and interest. For you, the damage is done already, right? So you just compute the provision that you need to keep on that amount. So there are substantial differences between stage 2 and stage 3, but at this stage we are concerned, we are seeing that if he is not in stage 1, his credit risk has significantly increased. So for stage 1 I'll compute next 12 months ECL, for 2 and 3 I'll compute lifetime ECL. That's it.
I
Right. So
have
when
one
we,
question.
yeah,
Yeah,
tell me.
I'm sorry, Tanmay. Yeah.
No, please
So,
go on, please.
yeah, before building the model, we need to, assess whether the accounts are in stage one, two, and three, and basis that we will build the model, right?
Yeah, absolutely.
Okay, thank you.
So your account has to be flagged as stage 1, stage 2, stage 3. Otherwise, how will you develop it?
Thank you.
Right? Okay. So, so I was just about to address that question next only. So that was my next point itself. You brought it up. And it really looks great to see the audience in such a form today. So it's been really a good discussion that is going on. So please be in this form, keep on bringing up as much as questions as possible, right? So I'm also working on IFRS 9 now. If something I'm unable to answer, I'll get back to my seniors and senior colleagues in office, and I'll get it clarified. I'll come back to you, right? So bring out as much as questions as possible, because understanding the regulations is very important before you start with model development, right? So with credit risk modeling and all, you would be able to get an idea of the quant side of it, but the regulation, knowing the regulations is very important, right? So in CRM, we will be talking about a lot about Basel models as such, right? So I think you can just so there all your doubts regarding Basel will get clarified, right? And this has been a trend, I've always observed even on my on the office floor. people tend to put Basel as a villain and IFRS 9 as a hero in the story, but it's actually comparing apples to oranges, right? So Basel does a separate objective, IFRS 9 is totally the separate objective, so no point in comparing that. So we'll come down to that. We'll talk more about Basel. We haven't done that till now. So on the CRM side, we'll first finish the data preparation modeling to some extent, and then we'll come to the regulatory side. And when we come to the regulatory side, there is going to be a lot of discussions on this part. So that's going to take up a lot of time. Okay, so as I was saying, so for stage 2 and stage 3, what we need to do is we need to develop lifetime ECL. Now the question that comes out over here is, how do we model these? What are the kind of modeling methods for this? So over here in this framework, when we are computing the lifetime ECL, right? That is where a lot of survival analysis and regression methodologies are going to kind of come in the story, right? So this will be something that now when we talk about PD model and scorecards, we generally talk about logistic regression, some of which we have already seen in the credit risk modeling, the modeling sessions. So over here, what we are trying to do is we are trying to kind of talk about the, so we'll not talk about logistic regression to that extent over here, but our focus over here would be more on the survival part, right? Or the bigger challenge over here is to develop the lifetime ECL model, right? So what are the challenges, advantages? We'll come to each of these parts one by one. So now the question that comes out here is that, okay, I have to develop next 12 months loss and lifetime ECL for stage 2 and stage 3 accounts. But the question is, how do I stage them? So I need to flag them as stage 1, stage 2, stage 3. Right. And once I have done that, then only can I go and say that, okay, these are accounts in stage 1. To them, I'll using these accounts, I'll develop next 12 months ECL. But how do I do that? That is the biggest question. So the starting point is to identify what are my significant increase in credit risk criteria. So when do I say that an account has undergone a credit risk and significant increase in credit risk, right? So this is where we start off our discussion with SICR. Now there are two broad criteria for SICR to identify accounts which have undergone a significant increase in credit risk. First is, if the present probability of default, PD, the borrower is higher than the PD at acquisition time. So if the behavioral PD the behavior PD is greater than the acquisition PD. So at the point of time when I was acquiring the borrower, right, I had a certain probability of default, because when the borrower was being hired, what could have been the dependent variable? So I'll just put a very simple thing. So y equals to 1 if good equal to 0 otherwise. Right. So this is where, so what I do is I estimate the probability of y equals to 1 using some model over here. right? So now the probability of y equal to 0 over here is the probability of being bad, or I can say this is my acquisition period. So probability of y equal to 0, 1 minus probability of y equals to 1. So this was my acquisition, right? So this is my acquisition PD. The probability y equal to 0 is my acquisition PD. So the probability of default, the probability of a bad borrower that I had at the time of acquisition. Now I have been placed into the, so I have given the loan, and from there what happens is I have been given the, so from there I've been given the loan, and once I've been given the loan, the next thing that I have done is, so basically when I'm there, once I've been given the loan, the account management team monitors me, and from there what happens is I have seen kind of the acquisition PD and everything, right? So what happens is, so basically now from there at a point of time there is a behavior PD that is generated for me. Now if the behavior PD at the point of time is greater than the acquisition PD, then what I'll do is I will say that I have undergone a significant increase in credit risk, right? So if my probability of default as on today is higher than the time when I was acquired on the books of the bank, then I have undergone a significant increase in credit risk. Clear?
Hi, Tanmay. So is it like we will compute the PD for every month?
See, it depends on the frequency when the business runs it. So if they can do a quarterly run, they can do a monthly run, they don't do an annual run. It's a quarterly or a monthly run as
Okay.
the business. Now, what also the business can do is depending on their you know kind of it can be a 6 months run. So it depends on the business. So there is no such rule that it has to be done monthly or. But generally, what business do a monthly run.
So these dates are like from date of recognition to the date of reporting, right?
The date of acquisition. So the
Okay.
account date open, right? So
Oh,
when you were given the loans, the first day your account was approved, right? So at that day you had a PD, and that remains unchanged, right? Now today standing say 10 months down the line you have a PD. So that origination PD versus this PD, if this
So
PD is higher,
Tanmay,
yeah,
any guidelines from IFRS 9?
as in guidelines regarding what, Anshu? Excuse me.
So any guidelines from IFRS 9, like after how much time do we have? Yeah,
No,
guidelines
no.
regarding when we have to recalculate the PD.
No, no. So basically, say you are running, you want to do,
Yeah,
you will be in the
guidelines
staging.
against when we have to recalculate the PD.
No, 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 no. No such guidelines. No such guidelines. So basically, say there were accounts which were acquired on the books of the bank on Jan 2016, right? So now at the end of Feb, the bank will run and it will see what are the stage compositions like, right? So as on 28th Feb, whatever is the so whatever is the probability of default and the date when it was acquired, so that difference is his. So that difference will be, if that is greater than zero, like if the behavior PD is greater than, behavior PD as on 28th Feb is greater than the acquisition PD of that account, right? Then it has undergone a significant increase in credit risk. Again, at the end of March, they run the code. So for this account, so this account was acquired in 2015. So from Jan 2015 when it was acquired, it had a PD. Now from that PD, what you are trying to see is what is his behavior PD at end of Feb, end of March 2016. So that difference is your. So if that difference is greater than zero, then you know that the behavior PD is much more, and then which implies that it has undergone a significant increase in credit risk. Generally, banks would like to know their stage distributions at the end of each month, right? So that's where they decompose the ECL figures and they look into it. Like say every bank does it around the 25th of the month, right? And so every 25th they compute the PD as per the new PD model for the account and the acquisition PD that was there, and the difference is greater than zero is a SICR and hence put to stage 3. Now, if that guide satisfies the bad definition as well, then it's put to stage from insert stage 2 it plays to stage 3. So it works that way. Right, Anshu. Or Anshu, shall I use an example, one more written example to demonstrate the fact, or are you clear with the explanation?
Yeah, I'm clear, but still, an example would definitely give me a more
Okay. So basically, okay, let's say this is the as on date. As on date is the reporting date, right? Okay. So as on date, let's say it's 31st Jan 2017, right? So then what I have is the account number, or account ID, which is, can you hear me now? Hello, am I audible? So account ID 001, right? So as on date after account ID, the next thing is date or account opening date. Right. So account opening date is 1st Jan 2050. Right. So I'll say it's PD account acquisition. It was a 0.02%. Okay. Now the PD as on date, so which is his behavior PD. The behavior PD that has been obtained by running the model as on 31st Jan 2017 is 0.09%. Right. So obviously you can see that PD behavior is greater than this acquisition PD. Hence the accounts SICR flag. CR flag is 1. Right. So the SICR flag is 1. Right. Now when I look into this SICR flag, if the SICR flag is 1, then the stage of the borrower is 2. So stage value is 2. Since the account has undergone an SICR, it is stage 2. So previously last month it was stage 1, so from there it becomes stage 2. Right. So now one thing is you can also look into the relative deterioration in the PD. So over here what you have is the absolute deterioration, right? So 0.09 to minus 0.02% is 0.07%. So 0.07 by 0.02 into 100 can also be your relative deterioration, right? So from there, by putting a cutoff on the deterioration, you can also find out whether it has significantly increased or not. So this is one way of doing it. Now the code is again the next thing. The staging, the bank again needs to know how their stage distribution is at the end of this month. So for the same account, so everything else remaining unchanged. So this will be 001. This will also remain similar. This PD will remain similar. Let's say this now is 0.07. So what is the SICR flag? It's 1. The account still remains in stage 2. So it since it did not have the bad, since it did not hit the bad definition, as you can also have a bad flag over here, performance bad flag, and you can see whether if it hits the bad definition, if 90 days past due or something like that, then you say, okay, it has moved from stage 2 to stage 3. So it's executed at the end of every month. So at the end of every month, the bank does a decomposition of its total provisions that it is keeping aside, or its estimated provisions from by multiple stages, by multiple products and everything. And they decompose the assets just to have a clear idea. So we'll talk about the decomposition exercises as well as we go ahead. But as of now, the significant increase in credit risk criteria is behavior PD greater than, if the behavior PD as on a reporting date is greater than the acquisition PD, then you know that there has been a significant increase in credit risk. Clear? Clear on this? Any queries, any questions, anything?
No, clear.
So
One question.
Okay, one by one,
Sorry.
So, yeah, who goes first? Is that Umang?
No, Piyush.
Piyush, hi. Yeah, Piyush, go ahead.
So, like, we can also use like Markov transaction matrix, like the way we have roll rate here, how the PDs are moving.
No, you need not know how the PDs are moving. So it's like you had a PD at acquisition, you have a PD at as on a given date. If it's greater, if the relative deterioration is greater than some cutoff, then yes, it's a SICR, else it's not. So it's a difference between 2 points, right? It's not, you don't need to have an idea of the flow.
Okay. But Markov chain can also be used for like roll rate analysis.
Yeah, so Markov, I mean, role analysis is actually an application of Markov.
Okay.
So
Thank
that
you.
is what goes on underneath, right? So that's the logic behind role rate and flow rate analysis.
Thank you.
Okay. Yeah, the next question. So someone was also asking the question along with
yeah,
Piyush. Go ahead.
yeah.
Yeah.
Tanmay, Pradeep decide.
Hi,
So
Pradeep.
just a question on the stages. So I was
Mhm.
thinking that an account can deteriorate but still be in stage two. Like the question is, can within the stages also there would be levels, right?
No. It's either stage 1, 2, or 3. Now
Okay. Hmm.
you are delinquent, right? But you're still not hit the bad definition. It means you have undergone a significant increase in credit risk, but still not impaired. So you are in stage 2,
Okay. Okay.
right? Yeah. Next question.
So Tanmay, here what have we done? Like, we are just calculating the impair, whether the account is impaired or not. Like,
No, we are trying to understand whether an account has undergone a significant increase in credit risk or not.
no. This I not like overall. What have we
Huh.
done? Like overall picture. Like, what have we done here? Like personal loans. Like then we are calculating where like we are going through the cycle of the
See,
lending book.
so our ultimate objective, yeah, I got your question. So our
Yeah.
ultimate objective is to compute the provision that I need to keep aside for this particular portfolio, right? So if I need to calculate the provision for the portfolio, I need to do it for each account and then add it up. If I want to do it for each account, I need to understand which stage the account is in. Now, if I want to do that, I need to know what is my significant increase in credit risk criteria, what is my SICR criteria, because basis that I will be putting the account into stage 1 and stage 2. Now, the impairment definition will give me the hint as to when to put an account from stage 2 to stage 3. Now, once I have done the staging, now I have stage 1, stage 2, and stage 3 accounts. I know that for stage 1, I'll develop the next 12 months ECL model. For 2 and 3, I'll develop the lifetime ECL model, right? Then once those two models are developed, I'll compute the provision corresponding to each account, right? For stage 1, stage 2, and stage 3, add it up and get my final ECL, which
And
will
all
be
these are
my provision.
yeah. So this all this are additive, right? Like every account there must be some ECL. Every account might have.
It's additive.
Okay.
It's absolutely additive. So that's the final objective. Now what we are doing over here is we have started with the first basic step, that is SICR, because until and unless I identify my significant increase in credit risk criteria and my bad definition, I cannot proceed anywhere.
So
right?
we are bifurcating
Because
the
those will
account.
give me the stages.
We're bifurcating the accounts,
Yes,
like
now we are in the process of, yeah,
by
we not
flagging
use the
them.
word bifurcating over here. We use
Okay.
the term staging the accounts.
Okay.
Because
Okay.
in IFRS9, doing the staging exercise is the most important exercise.
Okay. Okay. And this was with respect to personal loans. Product was personal loans today.
Yeah, let me just talk about this part once again. That whenever I'm doing this, right? So I'm doing it not only on the personal loans. I'm using personal loan as an example, but I will be doing this or I will be doing this for an asset which satisfies the SPPI criteria. That is a sole payment of principal and interest criteria. And personal loan is one such account. So I am just taking a personal loan as an example and see how it is valued. That is last that we saw last day. Now we are looking into the stages, right?
Okay.
So
This
now
could be for
how
commercial loan as well, right? This could be for commercial
yeah,
loans, the
a
same
commercial loan
process.
which satisfies the SPPI will have the same framework. Now what will change in a commercial loan? It will
The
come
behavior
the
pattern.
way the PD model is developed, right? The approach of developing the PD model that will change in the commercial.
Okay. Okay. Got it.
Right?
Okay. Okay. Got it. Yeah.
Okay.
And
Okay,
this is
so
for income
this
statement,
is
right?
what
This provisioning
SICR
for
is. Now SIC now when I'm, yeah, so when we're talking about
this is for
significant
income
increase in
statement.
credit stress, please come.
This is
Sorry. Yeah, please
yeah,
come.
yeah. This is only for income statement, right? This provisioning like would be put in like net income before the net income. This is all these provisions.
It's for the P&L statement. It's for the P&L statement. Yeah, it's for the P&L statement. Right. So this is one way you can identify significant increase in credit risk by comparing the behavior and the acquisition. Now the question that comes out is that there are now the thing is that there are certain challenges with this approach. What are the challenges? The challenges are that you are trying to calibrate two different kind of models into one space because acquisition model is developed on a totally different base of approach and the PD model is built up on a total behavior PD model is built up on a totally different set of accounts and it is as well likely that the two models may have totally different kinds of performance behavior or different kind of performance bad definitions. Then, if you are comparing this, right, the PD then and PD now using two different generated two different models, there can be an inconsistency, right? The the next question is how to overcome that inconsistency and move ahead. So that's the question. We start off the next session with the answer to this question. That if I'm using the output from two separate models which are developed on two separate population bases, because acquisition model is developed on a totally separate model base, behavior models are developed on totally separate base. So, so the question that comes out is that how do we go about doing this? So that is where that's the question that we need to answer. Because if two 3D measures are generated from two different models and there are inconsistencies or there are differences in the bad definitions and there are differences in their performance definition, then there can be an inconsistency which also needs to be taken care of, right? So we'll start with the question of how to solve this problem if this problem arises, and second, what would be alternate measures of SICR, right? So this is what we will start with in the next session. So next Saturday and Sunday we will not be doing the CRN sessions. We will be working on IFRS9 because there are lots to discuss, right? So next 2 days we'll Saturday Sunday we'll work on that. We'll get our doubts clarified. We'll pull this part up and then we'll start working with CRN, right? So so let's put a pause for the day over here. I'll share this recording today, right? CRM recording and this as well with you guys. So you'll have 4 recordings with you. So work on that, right? You'll get more doubts as you keep on going ahead, and we'll pick it up from there. in the next class. Clear?
Thanks, then.
Anytime.